You've probably heard it before. If you want to start investing in the stock market, you need thousands of dollars, maybe 10,000, maybe 20. The barrier to entry is simply too high for most people. But that's a myth, and it's a myth that's costing regular people millions of dollars in lost wealth over their lifetimes. The truth is far more accessible than you might think. And in this video, we're going to break down exactly how much money you actually need to start investing in index funds today. Let's start with the basics. 20 years ago, investing was genuinely expensive. To open a brokerage account and start buying stocks or funds, you'd often face account minimums of $500, $1,000 or more. Trading fees were a thing too. Every time you bought or sold a stock, you pay a commission, sometimes $10, sometimes $20 per trade. If you only had $100 to invest, that fee structure made it impossible. You'd lose a significant percentage of your investment just to open the position. But the financial world has changed dramatically. The modern brokerage industry is nothing like it was even a decade ago. Competition has driven down costs. Technology has made it affordable to serve smaller accounts. And one specific innovation changed everything: fractional shares. Most traditional brokers today have eliminated account minimums entirely. You can walk into an online brokerage right now and open an account with $0 in it. Some brokers will let you fund it with as little as $1. $1. That's not a typo. The infrastructure exists to accept your investment no matter how small. But here's where fractional shares really matter. Imagine you want to invest in an index fund that's designed to track the entire stock market. Some of these funds cost hundreds of dollars per share, maybe $300, maybe $400. Years ago, that meant you needed at least that much money to buy even a single share. Fractional shares changed that completely. Now you can buy a fraction of a share. You could invest $5 and own a portion of a fund that costs $350 per share. You own roughly 1% of that fund's price. That money goes to work for you immediately. You own real assets. You're getting real returns. So what's the actual minimum you need? Most modern brokers require $0 upfront to open an account. Absolutely zero. However, to actually make your first investment, you need at least enough to buy something. Some brokers let you set up automatic investments, and the minimum for that can be as low as $1 per week or per month. If you want a realistic starting amount, think about $50. $50 is genuinely accessible for most people. But it's a reasonable amount that someone could scrape together from a few weeks of small sacrifices. Maybe you skip 2 coffee drinks. Maybe you sell something you don't use anymore. $50 is real money, but it's not an insurmountable barrier. With $50, you can open an account at a major broker and purchase fractional shares of broad index funds. You'll own real investments. You'll start building wealth. You'll begin the process of compound growth that makes investing so powerful. But let's be realistic about what works as a schedule. If you're starting with $50, investing it all at once is fine. You've got your account open. You've got your position established. Now comes the critical part: consistency. The real power of investing comes from regular contributions over time, even small ones. Let's say you commit to investing $25 every week. That's $100 per month. Over a year, that's $1,200. Over 5 years, that's $6,000. And because you're getting returns on your investments during that entire time, your actual wealth growth will be even higher. $25 weekly is completely accessible. That's about $3.50 per day. It's less than a single coffee drink. Most people can find this amount by trimming their routine spending slightly. Here's a realistic schedule for someone starting from scratch. Week 1. Open your brokerage account. This takes maybe 15 minutes online. Choose a reputable broker. Most major brokers are completely free to use now. No monthly fees, no account minimums, no hidden charges. Week 2. Deposit your initial amount. $50 works. $100 is even better. $200 is great. The exact amount depends on your situation. Deposit what you can actually afford and won't need for at least 5 years. Week 3. Make your first investment. Open your brokerage platform. Choose a broad market index fund. A fund that tracks the entire stock market is ideal for beginners. Buy fractional shares with your money. Congratulations, you're now an investor. Then establish your rhythm. Every week or every month, invest a small amount. It doesn't have to be large. $25 weekly is perfect. $50 monthly works. $100 monthly is excellent. The amount matters less than the consistency. Many modern brokers offer automatic investment features. You can set it up once, and they'll automatically deduct the amount from your bank account and buy fractional shares. You never have to think about it. The money just flows into your investments like clockwork. Let's talk about the psychological part, because this is just as important as the mechanics. When you're starting with small amounts, the numbers might feel discouraging. After your first week of investing $25, your account might show a gain or loss of 50 cents. It feels pointless. But this mindset is exactly what keeps people poor. That 50 cents of loss or gain is irrelevant. What matters is the behavior. You've proven to yourself that you can invest. You've demonstrated that you can contribute money to your future. You've established the habit. Over decades, this habit compounds into genuine wealth. Consider the math over different time periods. Let's say you invest $25 every week, $1,300 per year. You'll need to find average market returns, and historically, broad market index funds return about 10% annually on average. That includes good years and bad years and everything in between. After 1 year of consistent $25 weekly investments, you'd have contributed roughly $1,300. With market returns, you might have around $1,430. The $200 seems small, but you earned it without doing anything except letting your money sit in the market. After 5 years, you'd have contributed roughly $6,500. With compound returns, your account might be worth close to $9,000. You've earned $2,500 that you didn't directly earn at your job. That's money created purely through investing. After 20 years, you'd have contributed roughly $26,000. With compound returns, your account could be worth somewhere around $110,000. You're not a financial genius. You haven't made any special trades. You simply invested a coffee's worth of money every week and let decades of compounding work for you. These numbers get even more powerful if you increase your contributions over time, as your income grows. Most people eventually make more money. When you do, you can invest more. Even just increasing from $25 weekly to $50 weekly makes an enormous difference over decades. So let's address the myths one more time. Myth number 1, you need thousands of dollars to start. False. You need $0 to open the account and as little as $1 to make your first investment. Myth number 2, investing is too complicated for regular people. False. Modern brokers have made it incredibly simple. You can open an account and buy an index fund in under an hour, often faster than that. Myth number 3, the fees will eat up all your gains. False. Modern brokers charge no commissions on trades. Many charge no monthly fees. The fees on index funds themselves are tiny, often less than 0.1% annually. You keep almost everything you earn. Myth number 4, if you don't have much money, it doesn't matter. This one's not exactly false, but it's misleading. Yes, starting small means your portfolio will grow slowly at first. But slow growth from today beats fast growth from someday. Every dollar you invest now has decades to compound. That's powerful. Let's talk about choosing your first investment. As a beginner, you want broad diversification. You don't want to pick individual stocks. You don't want to try to time the market. You want a fund that owns hundreds or thousands of companies across multiple sectors. The best option for most beginners is a total stock market index fund. This is a fund designed to own a small piece of every public company in the stock market. If you're in the United States, funds like VTSAX or similar products are ideal. They track the entire market with extremely low fees. You could also choose an S&P 500 index fund, which tracks the 500 largest companies. That's still incredibly diversified and still very simple. The goal is to buy something, anything, and then leave it alone. Don't check it obsessively. Don't panic if the market drops. Markets always drop sometimes. Markets always recover. Your investment timeline is decades, not days or weeks. The money you're investing must be money you can afford to leave alone for at least 5 to 7 years, ideally much longer. If you might need this money in 6 months, don't invest it. Keep it in a regular savings account. Investing works when you have time. For money you truly won't need for decades, investing in index funds is among the safest, most reliable wealth-building strategies available. The stock market has grown over every 20-year period in history. No 20-year period in stock market history has resulted in losses when you invested regularly in broad market index funds. Now, let's get practical about obstacles. You might say, I can't find $25 a week. Okay, start with $10 a week. That's under $1.50 per day. You can find that. Once you've proven you can do $10 a week for a month, increase it to 15, then 25. Small increases over time are sustainable. You might say, I don't understand enough about investing. Fair enough. You don't need to. You just need to understand that broad market index funds own hundreds of companies across many industries. When the economy grows, these companies do well and your investments grow. That's it. You don't need to understand quarterly earnings reports or technical analysis or any of that complexity. You might say, what if I lose money? This is a fair question, but let's be clear about the probability. Over any 5-year period in stock market history, broad market index funds have had positive returns most of the time. Over any 10-year period, they've always had positive returns. Over any 20-year period, they've always had positive returns.